So as a reminder, we have 15 AgriFood stocks reporting this month, and our ag, chemicals and rural services players not reporting at this time. So there's just a couple of points I wanted to highlight from this chart that just shows EPS growth relative to forward multiples. So firstly, as you can see, there has been a continuation of the trend we saw in August, where the large cap names, they're really trading on quite full valuations, particularly those with very strong growth outlooks. You can see in red there are actually 6 stocks where we forecast FY19 EPS declines, and 5 out of these 6 names are actually the mid to large cap companies. And finally, you see there at the end, the small cap names are actually, probably with the exception of Midway, generally trading sideways, and despite offering solid EPS growth and attractive relative valuations. Investors are currently preferring to pay up for liquidity. However, this is creating some attractive medium-term opportunities at the smaller end of our coverage list. If we just quickly touch on some of the themes we expect this reporting season, and I guess the key positives supporting the sector at the moment. So despite some concerns of recent concerns around the China slowdown, we do expect the more established China-exposed companies to report very strong earnings growth. The outlook for the emerging players, however, is more uncertain given the need to overcome regulatory hurdles. Treasury Wine Estates, Australian Vintage, Midway and Tassal should all benefit from high commodity prices and the low Australian dollar. And generally, balance sheets are in solid shape and well placed to fund organic growth opportunities or pursue further acquisitions. I guess at present, the sale of Lion Dairy and Drinks is the most topical transaction for the sector. The business is likely to be broken up. There is interest from Coca-Cola, Freedom Foods and Bega Cheese in varying aspects of that portfolio. But given the size of the transaction, any acquisition would likely require significant capital raising, particularly from Bega Cheese and Freedom Foods. So I guess despite some of these positives, there are a number of challenges in the space at present. In particular, the East Coast drought is causing input costs to rise and remains at sustained high levels. More recent trading updates from particularly the likes of Costa Group have sort of highlighted subdued operating conditions and a softer consumer. And we've also seen lower global dairy prices across the first half, and strong supply of fresh produce have seen weak prices there also. Basically, there's a number of unknowns also across the sector at present. So against this challenging backdrop, we're generally seeing lower upside risk to FY19 guidance, with companies more likely to reiterate guidance or potentially lower in the case of Bellamy's. So given full valuations and lower upside earnings risk, we're seeing quite high levels of short interest in the sector. You can see there Ingham's, Bellamy's and Blackmores are the most highly shorted stocks in our coverage list. And in our view, all 3 of those stocks do present downside earnings risk. Just turning to our key picks now, we do think the wine sector is at a positive point in the cycle and have recently initiated coverage of Treasury Wine Estates and Australian Vintage. TWE is the growth play, and its brand should be well known to your client base. It is a strong global business with a quality brand portfolio that enjoys pricing power. We do believe the company still has a strong runway of earnings growth ahead of itself, and it's attractively priced relative to its growth profile. Australian Vintage should appeal to those with more of a value preference. The company has very good sales momentum in the UK, and we believe there is upside risk to FY19 guidance. We think its significant discount to NTA should continue to narrow over time as management grows its branded sales and push into new export markets. With a vertically integrated business model, AVG also has corporate appeal. Its new Chinese distributor now owns 13.9% of the company and has been consistently buying stock on market since joining the register and board last year. And finally, Midway will deliver a materially improved interim result. It remains leveraged to favourable industry dynamics, and we expect its Japanese price negotiations in the second half will follow the 11% price rise it secured with its Chinese customers. It remains a key beneficiary of a low Australian dollar, has a strong balance sheet to pursue further acquisitions, and is also attractively priced. It's also worth probably touching on A2 Milk, as it has been a key pick in the sector. However, it is closing in on our price target now. From all reports, A2 continues to trade very strongly and grow its market share in the infant formula category. However, we also do expect a strong first half result, which would easily surprise on the upside across the P&L, cash flow and balance sheet. However, at this stage, we do not think management will change its FY19 outlook commentary. Given its strong run up until the result, it is possible the stock has a breather shortly after releasing. Just turning to fair value or outright sells, we do have a reduced valuation on Blackmores on valuation grounds. reduced recommendation, sorry. The company has flagged an increase in marketing spend to support its top line growth. As a result, we believe there'll be margin pressure in FY19. So as a result, we only expect Blackmores to deliver just under 10% profit growth in this year, which we do not believe is sufficient relative to its almost 30 times PE multiple. Cost Group, a messy result has been flagged there, but we do believe there's limited upside risk to management's medium-term growth targets. The company does require a moderate improvement in trading to deliver its calendar year 19 guidance. However, we do note prices across blueberries, tomatoes, and raspberries have improved since its lows highlighted in its January trading update. So I guess we have more comfort on FY19 earnings at present. However, I guess over the medium term, we still have concerns over the potential oversupply in the industry across tomatoes, avocados, and blueberries in particular, as these new plantings start to mature. And this will put downward pressure on prices, we believe, which we saw in January already. So given exposure to commodity prices, agri-risk, and increasing competition, we still believe its current valuation in excess of 20 times still provides little downside protection for investors. I just skipped past Ingham's there, which we still again suggest taking profits. The stock is trading at a significant discount to its international protein peers on circa 17 times FY19. The stock has defied an extremely challenging operating environment and key management changes to perform very strongly since the August result. I guess, however, given the prolonged East Coast drought and sustained pressure on input prices, we do believe there's potential downside risk to our second half 19 forecast and first half 20 numbers. As you can see, here in the two hard basket is Bellamy's and HRL. We expect Bellamy's to deliver a weak first half result, and there is downside risk to FY19 guidance given the strong second half result required. As a reminder, the strong second half is dependent on the success of the launch of its new reformulated infant formula range. We note the new range has been rolled out progressively this week in the last few days, and it is sort of at a $2 price increase from its previous range. We expect the company will increase its marketing activity for the new range shortly after the conclusion of Chinese New Year. And while we continue to like the stock over the medium term, it has run very hard over the last week into what will be a soft first half result with downside risk to 19 guidance, and also downside to our first half 20 forecast as SEMRA approval is taking longer than expected. So in the near term, we think the stock is high risk until we see evidence of improved trading and SEMRA approval is achieved. And just quickly on HRL, we do expect, well, it actually has released this morning, and it's quite a weak result due to the impact of lost meth testing revenue following a change in testing guidelines in New Zealand. However, taking a medium-term view now, we do believe value is starting to emerge, and that our original investment view remains unchanged, although delayed circa 12 months. Yesterday afternoon, you might have seen the company appointed Greg Kilmeister as its new chairman. I think most of you will know Greg as the ex-MD of ALS. So we view this appointment very positively and believe it can help restore credibility to the team following its disappointing trading update last year. So just in summary, key picks in the sector are TWE, AVG and Midway. We believe you can take profits in Blackmores, Costa Group and Ingham's. And we're avoiding HRL and Bellamy's for the interim result, but keeping an eye to watch for improved earnings certainty to turn positive on those names.